When you're ready to buy a home, choosing the right type of mortgage is just as important as picking the perfect house. Mortgages come in various forms, each with its own advantages and disadvantages. So let's break it down so you understand the different types of mortgages available and can determine which one might be right for you. Fixed rate mortgages are the most traditional form of mortgage. A fixed rate mortgage offers a constant interest rate and monthly payments that never change. This type of mortgage is typically available in terms of 15, 20, or 30 years. The advantages of this type of loan are predictability in budgeting and protection against rising interest rates. The disadvantages of this type of loan are higher initial interest rates compared to adjustable rate mortgages. Adjustable rate mortgages begin with a fixed interest rate for a set period and then adjust annually according to the market conditions. Common initial fixed periods are 5, 7, or 10 years. So the advantages of this are lower initial interest rates, making homeownership more accessible in the short term. Also a potential for decreasing rates depending on economic conditions. Now the disadvantages are the risk of increasing interest rates and payments over time and the uncertainty in long-term financial planning. Then there's the interest-only mortgages. With an interest-only mortgage, you pay only the interest on the loan for a certain period, typically 5 to 10 years. After this period, you start paying off the principal or the original loan amount. Now, the advantages with this type of loan are lower initial monthly payments and flexibility to invest the money saved on principal payments elsewhere. The disadvantages of this type of loan are higher total cost of borrowing as the principal remains untouched in the initial years. And then you have the risk of home prices falling, leading to negative equity. FHA loans are backed by the Federal Housing Administration. So FHA loans are designed for low to moderate income borrowers who have lower credit scores and minimal down payments. The advantages of this type of loan are lower down payments are required, like 3.5%. That's all you have to come up with on FHA. Accessibility to borrowers with less than perfect credit, 640. The disadvantages of this type of loan are mandatory mortgage insurance regardless of the down payment size, so even if you put more down, and the limitations of the amount you can borrow on an FHA loan. VA loans are available to U.S. veterans, active duty service members, and certain members of the National Guard and reserves. The advantages of a VA loan are no down payments required and there's no private mortgage insurance required. You also have really competitive interest rates on a VA loan. The disadvantages are the funding fee, and that varies based on the service type and the down payment percentage. Plus, VA is only available to qualifying members of the military community. USDA loans are meant to support rural developments, and they're available to rural and suburban home buyers who meet certain income requirements. Here it's west of I-95. The advantages are no down payment required, and they do have a little bit lower interest rates. Now, the disadvantages of USDA are geographic and income restrictions, as well as they require mandatory mortgage insurance. Choosing the right type of mortgage can significantly affect your financial future. It's important to consider your long-term financial goals and discuss your options with a financial advisor or a mortgage specialist. Whether you're looking for stability in a fixed rate mortgage or are willing to take a risk with an adjustable rate mortgage for lower initial payments, understanding the nuances of each type is key to making an informed decision. Contact me today so I can put you in touch with the right mortgage lender that's just perfect for your particular needs.